Hi guys, my name's Toby Mathis. I'm with Anderson Business Advisors. I'm going to be talking to you today about something called an accountable plan, what qualifies for it, what it is, why there's so much misinformation out there, why more people aren't using it. All that good stuff's going to start to make sense here. So the first thing is, what is an accountable plan? An accountable plan is an agreement by a company to reimburse its employees for expenses they incur for the benefit of the employer. So the easiest way to think about this is, if I'm an employee of a company and they tell me to go out there and incur an expense, like go get a cell phone or whatever, and then it reimburses me, that's an accountable plan. Now, this is the most important section, is whenever you look at an accountable plan, you're actually going to be going into the Internal Revenue Code, and this is actually contained in a reg. It's 1.162-2 for those of you guys like to read this stuff. And we're going to go way down, and we're going to go into the code for a little bit. We're going to find a subsection 4. And what it's going to say is treatment of payments under an accountable plan. Amounts paid under an accountable plan are excluded from the employee's gross income, are not reported as wages or other compensation on the employee's Form W-2, and are exempt from the withholding and payment of employment taxes, which is FICA, FUTA, retired railroad tax, you name it, all those things come into it. Now, the reason this is important is because that means it's not reported money when it goes into your hands. But on the same token, your employer still gets to write it off. Now you're saying, duh, I've been doing this forever. Well, this is what's interesting. Most folks don't realize that when you are a sole proprietor, or if you are a partner in a partnership, you are not an employee. That's why they don't have accountable plans in those types of organizations for the owner, because you do not qualify. Everything you receive is considered a draw. You also can't take wages, which, again, there's some downside. In order to do an accountable plan, you need to be some sort of organization that can have employees. In the case of an owner-operator, somebody who runs their own company, you're going to be pretty much stuck with two choices, an S-corp or a C-corp. Under state law, they're both the same. It's either going to be an LLC or a corporation, but its tax is going to be as a C-corp, where the corporation pays its own tax, or an S-corp, where you elect to have it pass through. In either one of those, you get to be the employee, even if you're an owner. And the reason this is important is because then these employer reimbursements are not reported. Now, why is this important to you? Because if you're having to report it, it's going on your 1040 somewhere. And some people would say, well, I used to write it off on my Schedule A, unreimbursed employee expenses. Okay, that's before the new tax law changes, because they removed miscellaneous itemized deductions, including including these types of expenses. But even before that, you were still subject to the 2% adjusted gross income floor, and those types of things still counted towards the alternative minimum tax. So we don't want to have something reported, because chances are right now you're going to get zero benefit from it. So we want to make sure that you get benefit, you get to have the cash, you don't have to report it, and the company gets to write it off. And that's where the accountable plan comes in. Why more people don't do this? Beyond me, because we've been talking about it for 20 years. Still shocked that there's accountants that don't know what this is. In order to have an accountable plan, you need to have an agreement. And technically, I always say put it in writing, although I don't believe there's actually a legal requirement, technical requirement, but you have to cover 4 things. Number 1, you need to have a business connection with the expense. So one of them that I talk about often is using an administrative office in the home. And it would still qualify as a principal place of business. You can actually do a reimbursement on the expenses associated with that home. And then everything traveling-wise between locations, if you have a main location and then you have your home location, becomes a business expense, which makes the car mileage, things like that, deductible. But you have to have a business connection. In other words, there has to be a reason that it's benefiting the employer. Number 2, you have to substantiate the expense. In other words, you can't just say, hey, I have a cell phone for $200. Please reimburse me. You actually have to produce something that shows that you spent the requisite $200, the company reimburses you. Number 3, you cannot have excess. In other words, if your expense is $170 and the employer gives you $200, the amount in excess is considered income to you. So you only incurred $170 and it gave you $200, you got $30 worth of income that you haven't properly reported. So you'd have to report it. More than likely, if you're an employee, you have withholdings that you missed. The employer gets fined, you get fined, everybody gets fined. It's not good. Last one is timely. This needs to be done within a certain period of time. Now, there's rules on this. Within 90 days, you should be good. Within, I think, 120 days of coming with some sort of a quarterly accounting, I would just get in the habit of monthly going in and checking, and like saying, here's the expenses that I incurred individually. Please reimburse me. Now, if you go beyond those, the 6 months or quarterly, or excuse me, the 90 days or quarterly, it doesn't mean it blows you out of the water. It means you're no longer in a safe harbor for timely. If they come in and audit you, there's always there's always the chance that they could say, hey, you didn't substantiate this, you don't have a true accountable plan. Though I've never seen it, but that would be the argument that the service could make. I suppose they would say, hey, you're not timely keeping this. Just keep some sort of record of these things. The who, what, where, when, and why of your expense. Use a smartphone, use a notebook, whatever. If it's something where the employer is going to be reimbursing you, in other words, if I have a C corp or an S corp, and it's something where it's going to be reimbursing me, just make sure I am keeping some sort of track of it. Now, what types of things does this involve? Everything from your cell phone to internet to cars, to computers, to access to services, to subscriptions, to even education. All sorts of things come into play. Reimbursing for meals, reimbursing for items for the business, office supplies, you name it. Chances are this company can start reimbursing you for things that it is using that you may have already paid for, or that you've been paying for, and the company can now start reimbursing you. It literally writes you a check for the item, and you don't have to report it. So it's not going on your 1040 as an employee reimbursement or anything like that. You literally just don't report it. The clear black letter law makes that undeniable. You don't report it. Now, in order to take advantage of this, obviously you have to be an employee. And if you're an owner or operator, it leaves you with 2 choices, an S or a C corp. Now, that's a tax designation. From a state level, you could be either a corporation or you could be an LLC, and then you could be taxed as a corporation. If that doesn't make sense to you, watch some of our other videos and we'll sink it in. Just know that from a IRS standpoint, you have to be an employee. And in order to be an employee of an owner or operated business, more than likely, the vast majority, you're an S or a C corp. And boom, you get to take advantage of an accountable plan. Again, one of the few areas that is truly beneficial for both you and the company, and works like a charm 100% of the time if you're following the rules, which is awesome. All right, guys, this is Toby Mathis with Anderson Business Advisors. Hope you learned a little bit something today about accountable plans.